G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with the founder of Alcove, the mortgage specialist, Chris Bates. Chris, how's your week been?
Well, it's doing well, Pete. Just went up to Newcastle on the weekend to see my mum. My wife's studying psychology, and it's a very stressful assignment due this Sunday. So I'm waiting for getting my life back on Monday morning. But yeah, spent the weekend up in Newcastle. Nothing too exciting to report on up there. But it's, to be honest, every year it's getting more and more enticing to move back to Newcastle. I don't think I ever will, but it's just got a real good vibe building up there since when I was a kid. But yeah, and this weekend, not much going on. It's been what a week. I mean, in markets, if luckily I'm not reading every single news article because I would not be sleeping around of the yo-yo what's going on with Trump. But yeah, that's definitely great expectations to shift dramatically. We saw a big weekend in terms of a lot of clients come back to us this week. So I don't know if it's just because of the Trump thing, but there obviously is a little bit more FOMO building in with people wanting to transact. I'm not sure what's been happening up there, Pete. What have you been up to?
Yes, I think it's a little bit more urgency. I think we've had a couple of people who made offers, they got knocked back, and they've come back with higher offers and just trying to make things happen. As you said, I think the driver of that, lots of daily headlines on what's happening with tariffs and tariffs being reversed, and then extended higher for China and so on. But I think what's catching people's eye, as you said, National Australia Bank straight out of the traps calling for emergency interest rate cuts in May of 50 basis points. I'm not so sure about that. I think it's probably not a good look for the central bank to move into panic mode, but it does look like market pricing is leaning towards a rate cut in May. And then NAB are actually forecasting further cuts in July, August, November, and February, which would take the cash rate target down to 2.6%. It's an enormous amount of monetary easing. So, and yeah, I think when you actually look at what's been going on globally, there's been a bit of relief, I suppose, overnight on the day that we're recording this, because Trump is potentially pausing some of the most acute of his tariff plans for 90 days. But I think we were chatting just before we started recording. I think the thing is, over the past 25 years or so, Australia has almost become a bit of a proxy for growth in the China economy or Chinese economy. And if China is going to cop 125% tariffs and responding with reciprocal tariffs on the US, that's going to have a knock-on impact for Australia, for our exports to China. And also, I guess, the trade diversion. If China can't dump all of its consumer goods over to America, they're going to be going elsewhere at fire sale prices. And I guess potentially a bit of a deflationary shock coming our way. And I think the oil price is down at about, $60 a barrel. So we should see some cheaper fuel prices after Easter as well.
Yeah, and I think that's just really the big point for this week is there going to be more inflation or less inflation with all this Trump nonsense that's happening? And, I think it's, you don't want to get too pigeonholed in terms of a belief right now. I mean, we've been tracking the ASX tracker in terms of where interest rate expectations are, because ultimately when the market believes something's going to happen, truly believes, I think that's when we'll see a lot of buyers want to enter and get ahead of those rate cuts. If you spoke to us maybe in Tuesday, it would be like, oh, wow, 50 basis points is guaranteed in May and maybe more. And the ASX tracker is really putting to, if you look even at Christmas right now, it's saying around 2.7 in December. I mean, it was only a week ago that was sort of showing 3.3, 3.4. So a big, that's probably 2 or 3 more cuts this year and a much lower number than what we expected a week ago. But I wouldn't say it's in the bag yet. Who knows what is going to come in the news cycle over the next few days. But if it does, a common belief that inflation is back in the, genie's back in the bottle, and Australia is really going to get hit with China, oil prices down, and inflation's not going to run on us, then the RBA is going to be really enticed to sort of do some significant cuts. And if they do that in May post-election and maybe APRA changes, it's going to shift sentiment a lot at a time of year when there's really low listings in winter. And so I think that's just something that's brewing. And I feel, maybe rates are going to slowly come down. The staircase is going to slowly drop over time. If there's some big cuts, it could make a big difference.
I did look at the totality chart pack. That's CoreLogic
Oh,
as
yeah.
was. Yes, and they do a nice little graphic to show the annual trend in property listings, and they do drop away typically in April as you go into that cooler period of the year. It doesn't drop off anything like as sharply as the Christmas break, but you do see just a general fall in the number of new listings and total listings normally through that middle period of the year. And they only start to pick up again typically around the spring selling season. So, yes, as you said, there can be sort of micro trends within markets, but generally speaking, we're not going to see so much stock on the market coming on for sale over the next month or two. And the election at the moment, it looks like we're going to stay with the incumbent. The betting markets have shifted quite handsomely back for the Labour Party. Maybe a general association between Dutton and Trump, I think, is how they've tried to position things. But it seems to be working if you look at the polls and the betting markets. So I guess that's a bit of consistency, no change of government, and potentially falling interest rates. I think, yes, you mentioned the oil price. I mean, China is already experiencing deflation. And if they're going to be dealing with a surplus of consumer goods that need to be dropped onto the market, potentially we could see lower goods prices ahead. I think even just in the market in general in Australia, if you look at the drivers of inflation, rental price inflation was down to 3%, according to Cotality. I nearly said CoreLogic. That's the lowest in 4 years. Construction costs are still going up, but only very marginally now, when previously they were doing inflation rates of over 20%. So that disinflationary trend does seem to be pretty much locked in. And if the next quarterly inflation figure is a 0.5 or a 0.6 on the core measure, I expect there'll be probably quite a bit of monetary easing coming this year.
I'm going to catch you off guard here, Pete. But did you watch the Chris Joy podcast with Mark Boris last week? Did you end up catching that?
Yeah, I did, but I say this in the most respectful way. I fell asleep while listening to it. That's not a reflection of the content. It's just that sometimes if you've got an overactive brain like myself, I tend to stick podcasts on it in the evening to go off to sleep. So that's not advice, by the way. It's probably a terrible thing to do. Go to sleep thinking about financial markets and bond pricing. But I probably got about 3/4 of the way through, and then thankfully got off to sleep for the evening. But it was pretty interesting stuff. And obviously, Chris is someone who's right at the cutting edge of what's going on in fixed income and bond markets. So it does seem to be, well, we've been through a dramatic shift actually in the last 2 or 3 weeks. And Australia's 3-year bond yield trading at 3.3% or thereabouts. I mean, that's a full percentage point lower than what we were seeing at various points in 2023 and 2024. So I guess that probably means lower fixed mortgage rates ahead and a general expectation that the cash rates will be drifting lower over the next 12 to 18 months.
Yeah, I don't want to really say it, but I feel like I should. We have seen a little bit of a mortgage war kick off in the last probably few days. I feel like I'm going to eat my words, and new deals and better pricing is probably not going to be sustainable. But we have noticed a little bit more competition from the banks and willing to compete for customers, and so it's going to be interesting to see if that sort of continues over the next couple of months. But yeah, I mean, what Chris basically highlighted was a really good point. I mean, I felt like he went a bit quiet on his forecasting around resi property. He got it wrong, and he was so very open talking about it with a lot of his AFR articles. He sort of went off the scene when, he kind of rightly pointed out that he kind of underestimated the impact that the population surge would have post-COVID, and how that created a rental crisis, and also was a real pressure behind creating demand and peaking prices up when people didn't really expect them to kick. But I mean, what he basically highlights is that, we're moving into a real easing bias. He sort of said that led to a cut, and the correlation of that to prices, that it could start to create a little bit of a run. And that was pre, obviously, everything that's happened with Trump. So it was a good podcast, and I always sort of like to listen what Chris has got to share. What's some other stories that we've got here, Pete? I mean, the apartment new build prices, it was a cracking from Urbis.
Yeah, well, let's go through our big 3 news stories of the week. We've already sort of drifted into the shifts in financial markets. It might just be worth doing a bit of a recap on on what's happened and why with tariffs. I think if you back up the truck 20 or 25 years, I mean, it's not so long in the distant past that the US was running surpluses. Clinton administration, when people used to talk about the merits of a balanced budget. But then when the global financial crisis came along, there was the collapse of Lehman Brothers, all the bailouts, massive deficits, $1 trillion deficits, and then all of those bouts of quantitative easing or money printing. Every time the stock market went down a few percent, on came the printing presses. And then I think during COVID, we've just got used to this idea that fiscal deficits in the US, 1 trillion, 2 trillion, sometimes even 3 trillion, 5% of GDP. It's just almost become baked into the system. And it's kept the economy running along really well, kept unemployment low and growth happening. Everybody's happy because the stock market's going up. But US has got a national debt now of over 36 trillion. It's just an extraordinary sum of money that's going to need refinancing. And what Trump really wants to do is firstly try and bring that budget down towards a more balanced position, but also refinance the national debt as bonds roll over at lower levels, ideally. Plus, he was a realtor, right, by background. So he's trying to push down interest rates. And the only way he can really balance the books, firstly, he can cut spending. And we've seen how popular that's been with all the protests all around in Boston and all around the US. And the other way is to increase income. So 125% tariffs on China. Obviously, this has got massive knock-on impacts to global trade. China's responded with reciprocal tariffs. So I guess you can't just assume that company earnings are going to keep growing like they have been for the past 15 years. Definitely a risk of US recession. Stock markets got annihilated before we had a bit of a relief rally this week. So I guess that's what the backdrop is. In terms of what it means for Australia, well, if China is going to cop the worst of the tariffs, well, yes, it could have a negative impact for us, hence all of the interest rate cuts being priced in. I think there's a few things that do act as really good shock absorbers for Australia. Firstly, we've got the free floating currency. So the Aussie dollar straight away dropped to under 60 US cents before bouncing a little bit. Secondly, we do have control of our own interest rates. I think some other countries like the US, where most people have maybe a 30-year fixed rate mortgage, well, different setup here. I think a lot of our funding is based around 3-year bond yields and movements in the cash rate. And so most people are on variable rates, and we'll see lower interest rates for consumers ahead. That's the second thing. And the third thing is we've just got low government debt compared to a lot of other developed countries. So if the worst comes to the worst, the government really can stimulate with some more spending. And worst case scenario, we can do a real stimulus package, I would say, variously. So I think that's, generally, I mean, I've seen all the usual news and views around social media, but to my mind, that's bullish for property. Lower mortgage rates. We've got the biggest housing shortage in living memory, and a lot of people who've become attuned to property prices rebounding and going up pretty much every time interest rates go down. I suppose the one thing pulling in the other direction, as you said, lending standards are just very, very tight. Lending assessment buffers at a record 3 percentage points. But just some lenders are now starting to find ways to lend a bit more freely, and maybe a bit of competition on rates as well.
Yeah, I think that's the sort of the big point, right, Pete? If you get some major interest rate cuts, that's going to increase borrowing capacity. Then is the pressure for APRA to step in? Considering the size and the velocity of those cuts, that increases borrowing capacity. You've still got a rental crisis and investors sort of buying in areas that are typically not bought in the past. So they are active in the market, but they're not, covering where current investors are. And then if there's a bit of FOMO kicks in, right, the desire of if I don't get a home or I don't upgrade my home now, I'm not going to be able to do it. And it's just the overconfidence in property. I also wonder if just every time there's a freak out in the property market, everyone in the share market, everyone just thinks, oh, property's a safe haven, because they don't have to feel the volatility. And I feel like every time even if this correction bounces back, it almost does some damage to people's psychology around investing in their their super, and it makes people just want to rush to what they in their mind think safe assets like property. But if property was valued every day, I don't think people would feel as confident. But do you think that mental accounting, Pete, and property seen as a safe haven, and particularly when interest rates are coming down, there's an overconfidence belief that prices are going to go up, and all these sort of emotional benefits drive the beliefs drive the market just as much as what should be driving the market and the fundamentals.
Yeah, there's a massive behavioral advantage in property. I mean, there's two different ways to sort of invest in property. One is to develop or manufacture growth, look for opportunities, and the other way is to sort of buy and hold properties for the long term. And it always amazes me when I do my tax return and I'm looking at properties and you put in the acquisition date, 1996, 2009, all these properties that are owned for, 16 to 25 years. I can't, except for I've got some sort of footsie trackers that I've owned for that long, but in the stock market, you very rarely hang on to investments for that long because, there's, for one thing, it's liquid and life gets in the way and you need your money for something else, or then you get these big wild swings in the market like we've seen over the recent weeks, and that kind of spooks a lot of people out. Property people tend to think of very much more as a set and forget type of investment. Not all the time, but certainly the average hold period has increased quite significantly over recent years, given the transaction costs. So, I think there's definitely that thing. And I suppose as well, I mean, if the Labour Party stays in power, well, we're going to see big population growth just on an ongoing basis for years into the future. I think the opposition was talking about potentially trimming immigration and student caps and so on, but I don't think we're going to see much of that from Labour, and it just creates an awful lot of demand for housing around the usual capital cities and regional hubs. And there's, I suppose, a general belief. We've got over 100 years of data to show what land prices have done, and the double-digit growth in a lot of areas over 100 years. So it does sort of encourage people to stick around for the longer term.
Yeah, I think you've Catality. It's going to be hard to remember to not say CoreLogic, but I mean, their monthly report came out this week. It's always something we've mentioned many times on this podcast to have a squeeze. It actually showed CoreLogic on it, so they haven't updated that yet. But the total listings, which is what you sort of mentioned before, is if there is a spike in demand, i.e. what's happening this week, and it happens at a time when listings are still quite low across the country, then they're the two ingredients to create a little bit of mini boom. And the same thing happened in 2019. Supply was getting tighter and tighter and tighter. Demand was building, and demand rapidly increased with APRA, Liberals winning the election, and then some rate cuts as well. And so, I just sort of thought I would throw that in there, and hopefully no one really bailed out of the investment markets on sort of Tuesday when there was, or Monday, whatever it was, when there was a lot of fire selling, because the market's bounced dramatically since. I'm not sure where it's going to end up in the future, but it just sort of shows us the ride people went on, because the amount of news and the fear of maybe another 2008 is going to happen again. It really affects people's investor psychology and their confidence to stay invested.
It's often people who are leveraged in the stock market who get forced liquidation just at the worst possible time, and they get spooked out of the market. But I mean, we're not out of the woods yet. Even though Trump has sort of backed down a little bit, we're still facing effectively the biggest increase in tariffs since the 1930s. And there's going to be some fallout from that. We can't just expect company profits to keep on rising relentlessly as they have done for the past 15 years. So stick around. We're going to do 3 listener questions at the end of the show today. Let's do our second story of the week. Apartment prices soar for new builds. So this was a report from Urbis. Off the plan, unit prices are up 33% over the past year, following a big leap in the fourth quarter of 2024, driven by Brisbane, where prices are up 34% for unit pre-sales in 2024. So that takes the price per square meter all the way up to 19,000. It's about double what it was in 2019. I think, Chris, there's a bit of a compositional change here. I think there's more sort of owner-occupiers going into the new apartment space, downsizers, right-sizers, people who want, potentially that lock-up and leave style properties. Nowhere near as much being driven by investors, foreign investors from mainland China and so on, like we saw in the previous cycle. And I guess Urbis's report suggested that, yeah, volumes of new unit supply are still pretty modest and actually tracking below average at this stage. So, yeah, maybe some rate cuts will help in that regard, get supply starting to shift again. But I've been thinking for a long time we would need to see higher prices for new apartments just to get supply moving, because at the moment there's just not a big enough differential between established unit prices. There's very little motivation, I guess, for developers to build and make profit. There's just not enough margin been there. And I think they're just having to build a different type of product to get stuff out of the ground.
Yeah, I think they're going to have to absolutely target the affluent downsizer, right? Who's willing to doesn't need to borrow money, isn't affected by lending changes, and can actually meet the market. And I guess the quality of the apartments, I feel, is just getting better and better every year. We're actually going up to the Gold Coast this time next week, and the amount of building that's happening up there is just going to be nice to sort of watch, really, and see. I went up there a couple of years ago, and I was sort of, I guess, surprised with how much building was going on. But just tracking urban developer, it's like almost the hotspot of the country, how many new builds are going on up there. So there's a reason why they're selling. I think and this would be when you say compositional bias, this is a prime example that, they've shifted from, say, investor-centric sort of small apartments to, whole floor, or half a floor sort of apartments getting sold for cashed up downsizers, and potentially even families as well moving up there. But I think unit prices are going to have to increase, but I think also borrowing capacity is going to have to increase to allow people to be able to borrow to actually meet what the developer wants to be able to sell at. So I think it's going to have to be borrowing capacity goes up first, then developers can actually sell their product, then they're going to be actually going to be able to build. So everything's on hold till borrowing capacity increases, hence why a lot of the banks are trying to do everything they can. We saw some innovation this week with CBA changing how they look at HEX policy. And, if CBA doing it, we'll also see other banks do it. I haven't seen too much more on longer loans, but I think that's going to start coming in. A lot of banks will lend on last year bonus versus the averages, and anything they can do to increase lending, I think they're trying to do. But rate cuts and APRA stepping into the two big ones, everything's on hold till they happen.
Yeah, so I guess just to wrap up on that second story, Urbis said the selling price of apartments in Australia's capital cities jumped a record 24% in the December 2024 quarter, as building costs, labour shortages, and a shift towards owner-occupier grade stock pushed the average over $19,000 a square metre for the first time. And I think developers are just generally saying below that price, it ain't working for them and they're not going to build. As you said, some of the hotspots have particularly included parts of South Melbourne, Broadbeach in the Gold Coast, and some of those markets. So I think, generally, if interest rates start to come down, I think developers will get a bit more certainty. Construction costs are leveling off, but we're still tracking a long, long way behind the Housing Accord target of about 20,000 dwellings a month. We're probably running at about 15 or 16,000. So cumulatively, we're 50 or 60,000 behind where we should be already. So pretty challenging times. Well, the third story, which we've already sort of touched on, APRA, the changes to the treatment of help debts, previously known as HEX debts, I think. I struggle to keep up with the terminology sometimes. And APRA had previously proposed a bit of a change or an adjustment to the way that those types of debts were treated. So removing help debts from debt to income reporting. Because I suppose a student debt in some ways is not exactly the same as a consumer debt. Doesn't always need to be repaid immediately, different loan terms and so on. And CBA actually announced on the 8th of April, so Tuesday, on the week just gone, that they're making changes to the way in which they view customers' help debt, and therefore a lot of sort of new first-timers will be able to maximize their borrowing capacity. They've obviously got to ensure they can comfortably deal with the help debts as well. But I think, Chris, this feeds back into what you were saying, is that, lenders can see there's a housing shortage, interest rates are coming down. There's going to be a lot of appetite for lending, I think, over the next year or two. What are you seeing in the market generally? I've spoken to a number of clients over the last 6 months. Some of them have been pushed out to go and they've been forced to go and use their non-bank lenders. Some of the people who are doing small developments and things like that because banks just can't get the assessments to stack up. And sometimes that's meant paying a higher mortgage rate just to get deals done. But what kind of things are you seeing in the lending market at the moment?
Look, I do think there's a lot of debt stress in the market, particularly people who have leveraged up 2020, 2021, 2022. But they've done everything they can to hold on. And we have seen a few clients downsize. I think it's just because it's just been up now. We're talking almost, was it 22 or 23? I'm trying to remember now when the rates started going up. I think it was late 22, wasn't it? Or mid 2022, May 22.
I'll have to look it up. Yeah, I can't remember. A while ago.
The years just tick over. But I mean, it's just been a number of years now where rates have been higher and unexpected. And, some clients, they've been able to sort of ride that wave okay because they've had some massive salary increases and maybe they're, in a couple, maybe more hours are happening and some promotions or businesses doing well. But I think for some other clients, they've exhausted all their buffers. And a lot of them are coming off fixed rates still, even though we've had clients just come off 4-year, 2% fixed rates. And so there's still a little bit of the fixed rate cliff still working its way through. But I do think they're going to be selling into an undersupplied market. And a lot of them have actually, even some clients we've had to refinance out of the big banks to lenders that are even higher interest rates just to keep them in homes, basically. They'd rather pay a higher interest rate and still be able to afford my mortgage than sell my property and have to pay stamp duty and selling costs, etc. So particularly ones who have also bought investment properties. And, we have to go to sometimes non-banks just to get the ability to refinance and extend interest-only periods, etc. So, yeah, and I think that, they are all hoping for rate cuts. But even if there's 1.5% rate cuts, you're still talking, 4.5% that you'd be paying to a bank. It can still feel like a big mortgage versus when they signed up at 2s and 3s. And so I do think you're going to still see a lot of people, unfortunately, having to bail. But I think the banks are just very incentivized right now to do everything they can to increase borrowing capacities. And I don't know, I'm going to bet that some innovation happens over the next 6 to 8 months that borrowing capacity starts to really go back up again.
I was just looking at the rate hiking cycle. So interest rates went from 0.1% cash rate target in 2022 in April, all the way up to the final hike was 8th of November 2023 to 4.35%. So all the way through 2024 and for the first couple of months of 2025, the cash rate target was 4.35%. And then on the 19th of February, the first rate cut, it really just removed the last hike in the cycle to take us back to 4.1. I guess if you look at modeling, it's generally perceived that the neutral rate might be about 3.5 or something like that. So, but that's probably where we're drifting lower to. But if there's a risk of recession, that would be the absolute minimum of easing. We would need probably 4 or 5 cuts to get things moving again. So, yeah, it's as you said, it's a rapidly changing environment at the moment. Even in the space of 2 or 3 weeks, we've just seen an enormous shift, a very dovish shift in market pricing, just off the back of tariffs, which, to be fair, Trump had telegraphed earlier. But I suppose seeing is believing, and now people are thinking there's going to be some knock-on impacts as China experiences the impact. So we do have a few listener questions that we can go through. So send any questions, as always. The link's in the show notes. Chris, here's one for you on debt recycling. A bit of a specific question from John. My wife and I have one investment property, but we've hit many barriers with trying to build a property portfolio because our borrowing capacity is severely limited, kids and reduced working hours. So now we want to debt recycle our way towards an early retirement. So our plan is basically to refinance some properties, put some equity into ETFs to pay off the home loan, and then debt recycle our home loan over the next 5 or 6 years. And then 6 to 10 years time, once the home loan is paid off, put the surplus cash into offset or redraw, and then effectively use the dividends to reduce investment loans. I guess there's, without going too much into the specifics there, Debt recycling is something that was variously popular at different stages in the cycle. But is that something you get your clients doing much of these days?
Oh, I don't really like the word recycling, to be honest. I think there's a financial planning strategy that planners love strategies, right? They like little tools in their toolkit that they could put into statements of advice that are going to show the value of their advice. And that's just me. I've been an advisor for a long time. We sold our advice business back in 2020. So I know the game, and that's not a shot at financial advisors at all. But there's only so many tools in their toolkit, right? Salary sacrifice into superannuation, spousal contributions, maybe open a SMS and reducing the costs in super, make sure you structure your insurance right and get your will and testamentary trust and potentially, restructure your home loan and save some interest there. So there's definitely lots of things that they look at. And debt recycling is one of those things that they sometimes recommend. I think there's a real challenge with it personally. I think the issue you get is when you release equity and whether you're buying that into, and usually you're buying into shares. I think your first bet is, not trying to outperform share markets. I think that's a pretty good call, right? But there's a cost to get that equity. Let's say it's 6.5%. And you might get some dividends on it. And often with share investing that you want to basically reinvest those in dividends so you can sort of accumulate a portfolio. And so, yes, you get some income, whether you take that in your bank account or whether you just reinvest it, that's up to you. But I think that's, often it's good if you can just reinvest it to keep on building an investment portfolio. But that negative cash flow, you're going to have to afford, and maybe it's tax deductible for you, which is good. But so the problem is that even if you went and bought 100,000 and it did quite well and it made 7-8% a year or whatever it is, and you did it for 5 to 10 years, after you pay capital gains tax, like it's not going to quickly just pay off hundreds of thousands of dollars off your mortgage. It might make a small tweak. And if the problem is recycling, is if you then sell it, you pay capital gains tax, you pay off your home loan, then you got to re-borrow to then go and buy more shares. Like, are you really getting ahead that much by recycling? And when you're maybe only talking, a few $1,000s, because you got to pay off the loan, right? So, you got $100,000 loan. Let's say, it went to 130. You sell the 130,000. You pay capital gains tax. Let's say it's $5,000. You got 25 grand net. You got to pay off your 100 grand. You've already paid your home loan off 25,000. Like, is it really making you much money debt recycling? I'm not such a big fan personally. I don't think it creates the right behavior. I think you should just, if you're going to use equity to buy shares, you should use that equity, you buy shares and you keep them. And you dollar cost averaging by putting in more money as you can. The more that you equity get in your home, the more that you release and the more you buy your shares and keep paying off your home loan. So I don't really like the word debt recycling, Pete. Hopefully that made sense, because it is something that's often misadvised, I would say. And the returns you believe are possible once you've actually done the numbers aren't really there to make a huge difference.
Very cool. Okay, let's go to a couple more. Second question from Rich on Airbnb. My partner and I are about to move in a new home in a tourist hotspot along the Great Ocean Road. Very nice, but too windy for me. We were thinking we could Airbnb the property occasionally to help with mortgage repayments, e.g. at peak periods, Christmas and Easter, for example. However, we've recently discovered there's some tax complications to renting out your home when it comes to time to sell it. Can you please discuss the pros and cons of Airbnb and being your primary place of residence, and how you might decide if the short-term income from renting it out outweighs the long-term shortfalls in capital gains tax? So just to speak in general terms here, this is how the tax ruling works. So basically, place of residence is typically exempt from capital gains tax in Australia. However, if you do use your place of residence to earn income, then you're not actually eligible to get the full capital gains tax exemption when you come to sell your home. So it's done on a prorated basis. So it's basically a portion of your property based on the floor area that you rent out, which it sounds like might be 100%, but also the length of time it's rented out. I mean, that portion would be subject to CGT. Look, it's a complete numbers game here, and you really have to look at the specifics of your case in point. But I would say, but generally speaking, look, I've got a property at Darling Harbour. I've often been thinking maybe I should flick it onto Airbnb, because over Christmas and New Year, for example, people want to watch the fireworks. There's massive demand, and you could rent out for a really good price. To the extent that though you wouldn't really want to be there yourself. The same would apply on some of the key school holidays or Easter. So I would say, yeah, look, it actually financially probably does make sense to Airbnb. I suppose there's a couple of things, wrinkles there. One is that Airbnb takes a clip of the ticket. Property managers who are managing Airbnb also take a very big clip of the ticket, could be 18%. So you're probably going to lose maybe, like, let's say about a third by the time you've paid for cleaning costs and so on. A third of that rent might go in costs. But if you can get a really good price over Easter or Christmas, then it could be worth it. But it really also depends on, well, how much you're expecting to make on the gain of your property, when are you planning to sell and for how much. But if you're only renting out for certain portions of the year, then actually the CGT impact would be lessened because you're not going to get CGT for the whole time. But I would say take some specific advice on that one. Anything to add on that one, Chris?
I think definitely get some tax advice on this. It can get a bit murky, these waters. And I agree with you, Pete. Often people miss the potential CGT impact is they go, oh, yeah, I might as well I'm living in my home. I'm going to rent it out and I'm going to go and live with other family members. And all of a sudden they're renting it quite a lot on Airbnb to cover the mortgage, but that could have a huge impact on their CGT. I agree with you. And once you take the Airbnb fee, cleaning fee, the hassle, etc., and then potentially paying tax on that money as well, right? Are you actually making too much money? But there's some times of the year, and if you can get an exemption from the CGT because the amount of days that you're doing it, and it's not doing it that much of the year, potentially you should take the money and run, right? Like potentially for somewhere like the Great Ocean Road, and you can rent it for a massive premium every January and get an exorbitant rate, and you want to go away every January. Well, potentially it's a good idea just to rent it out, but definitely understand it within your accountant and how that would affect your CGT. So you've highlighted a big misunderstanding that, yeah, just being your home is kind of cheap income. You're not going to pay any taxes on it. Well, no, the ATO is all over it, and their access to data is better than ever. And particularly getting it from Airbnb doesn't seem to be a challenge for them.
You can imagine what it's like around here in Noosa. There's places on Witter Circle renting out for 20 grand a week over Christmas. Yeah. And why would you stay if you could take $20,000 a week at a time when everyone else is piling into Noosa? You'd be better off going to Bali or go somewhere else, go to the hinterland and enjoy some time off. But anyway, third and final question from Jack of View Trades. How can you balance a property's competing positive and negative attributes? One particular example is weighing whether to buy a good house, walking distance to the beach in a cool area with strong historical longer-term growth and a solid yield, available at a fair price, but it's separated from a main arterial road by a council nature strip, so it gets quite a bit of noise from the road during peak times. It's a damn dilemma. I suppose there's two conflicting things there. One is you've got a long proven track record of capital growth, so that tends to be a good thing. It's the old Lindy effect, I suppose. The longer something's been a proven performer, the more likely it is to continue being so. Road noise is a challenge. I know there's a theory out there that maybe as we get more electric vehicles, then roads generally can get a bit quieter over time. I think there's some merit in that. But also roads are getting busier in Australia too. I mean, look, the oldest cliche in real estate is location, because you can fix anything else about the property, decor, floor plan, various things on the landscaping, but you can't change the location. So that's why people try to focus on worst house, best street. But what do you reckon, Chris? Would the proven track record outweigh some negatives on the location, or would you hold out for a better block of land?
Oh, I think Jack knows the answer to this. The reality is it's probably not selling this property. It's probably, if it was hot as, you'd probably already gone by now. I think if it's hard to sell or hard to buy, hard to sell in any market, so you're trying to buy it, I think when you try to sell it one day, it's going to be hard to sell. And unless it's a really big, strong boom market. So the problem with buying a property that's compromised is that, yeah, you might be able to get it as a discount now, If you try to sell it in most markets, other buyers are going to want a discount in the future. They're not going to want to pay a premium price unless it is a complete boom and everyone is so desperate. So you lose the ability to sell it and it doesn't come as liquid. And if it's a really bad market where, there's a lot of fear and negativity, then people are going to want a bigger discount. So you've got to be really careful buying any property, I believe, that's got a really strong, red flag on it. That basically you've got to make sure that you basically lose control of selling it. And so, whereas a great asset, might be a bit harder to buy now. It might take you a lot longer to buy it. Might not have to pay a little bit more than you wanted to. But ultimately, in any market in the future, if you want to sell it fast, you can. And I do think there's value in having an asset that's quite liquid and the ability to move in the future, because who knows what your plans are in the future. So, and I think you will get better growth on those type of properties, because if you end up selling those in booms versus the poorer properties, I think you can also get those premium prices and less volatility along the way. So I'd probably go a little bit further out and potentially get something on a much quieter road, something that families are going to want to compete on, rather than a property that maybe everyone rocks up and says, oh, I just can't deal with this. It's too noisy and it's just too dangerous. And I just don't want to, it's close to the beach, but this issue.
Even if it means taking on a reno or changing a floor plan or something, you don't have to do that on day one, right? You can do that over time. So that's almost about it for this week. Chris, what are you doing on the weekend?
Not too much, mate. Just going to take the kids to, I think, Botanical Gardens down in Western Sydney. So that's who I'll take for a bit of a day trip. Let the wife get her final assignment submitted and play football on Sunday. What about yourself?
Well, if you're watching on the video and you saw a little smirk come on my face halfway through, it's because my Broncos tickets just came through for Friday night at the Suncorp. So the kids absolutely love those late night games. It's a bit tiring for me, to be honest, trying to drive home through the traffic at 10 o'clock. But it's they're off to a flying start this year. So and the AFL's away the next week or two for the Lions. So we're plugging the gaps with some rugby league. The kids don't seem to care, to be honest. They'll watch anything. So that's my weekend. And then Easter's coming around relatively quickly. Plus, we've got Anzac coming up as well, so there's lots going on.
Yeah, and Easter, Anzac, then the election, and the RBA. So I think it's what's going to happen in the next 6 weeks, let alone what Trump pulls out of his hat. So good to chat, Pete. Hope you have a good weekend, and thanks for listening.
Cheers. Thanks, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.